In 2020, Lexus sold roughly 230,000 cars in China. By the first 4 months of 2026, that number had collapsed to under 50,000, a 34% drop in a single year. In the United States, the brand just posted its worst quarter in years, sliding by double digits, while its own parent company was busy absorbing a tariff bill north of $9 billion. And in the middle of all that, a Korean brand that didn't even exist a decade ago just got named the best luxury car brand in America. The cruelest part is the timing. Lexus had just closed out 2025 with a record year in America, with over 370,000 vehicles sold, up more than 7%. Then the floor dropped out within a single quarter. Here's the part that should worry every luxury automaker watching from the sidelines. None of this happened because Lexus got worse at building cars. The reliability numbers haven't moved. The build quality hasn't slipped. What actually happened is that the exact economic conditions that built the Lexus advantage back in 1989 have quietly reversed and turned on the brand that benefited from them the most. So how does a formula durable enough to survive 3 decades, a global financial crisis, and a pandemic suddenly stop working in about 18 months? The honest answer isn't really about Lexus at all. It's about trade policy, currency, and a company that just picked up Toyota's oldest trick and used it against the brand that invented it. Keep that in mind as we go, because by the end of this video, that last part is going to matter more than almost anything else we cover. We're going to start at the very beginning, back when a piece of American trade policy was the entire reason this brand exists at all. To understand what's breaking, you first have to understand what Toyota actually built, and why it built it in the first place. In the early 1980s, Washington leaned on Tokyo to cap the sheer number of Japanese cars entering the United States, a response to Japanese imports climbing from roughly 11% of the American market in 1969 to over 28% by 1980. That single piece of trade policy quietly reshaped an entire industry strategy. If Japanese automakers could no longer win by shipping more units into America, the only path left open to them was shipping far more expensive ones. That's the environment that produced Lexus. In 1983, Toyota chairman Eiji Toyoda gave his engineers one instruction, reportedly telling them to build a car better than the best car in the world. That order became a secret internal effort known inside Toyota as the F1 project. The company spent 6 years and more than $1 billion on it, building and testing roughly 450 prototypes before anyone outside the company ever saw a finished car. The result, unveiled in 1989, was the LS400. It wasn't just an engineering flex, it was a pricing decision. Toyota deliberately set the LS400 about $10,000 below a comparably equipped Mercedes-Benz, chasing buyers who were realistic and sensitive about value rather than status alone. The ad campaign built around it promised a relentless pursuit of perfection, and the car backed that up almost immediately. A year later, Lexus topped J.D. Power's initial quality study. The year after that, it swept the top spot in 3 separate J.D. Power rankings simultaneously, a feat no automotive brand had pulled off before. That's the entire Lexus formula compressed into one sentence. German engineering standards, at a meaningfully lower price, backed by reliability data nobody could seriously argue with. Notice Toyota wasn't alone in reaching that conclusion. Honda had already launched Acura in 1986, and Nissan launched Infiniti the same year as Lexus. 3 separate Japanese companies landed on the same strategy within a few years of each other, which is usually a sign that the strategy wasn't a creative insight at all. It was a rational response to the same trade pressure squeezing all of them at once. If you've ever wondered why your uncle's 20-year-old Lexus still runs like it just left the dealership, subscribe, because we're about to walk through exactly how that reputation got built and exactly how it's being taken apart in real time. The formula scaled fast. Within a year of its launch, Lexus was already selling in 17 countries. Today, it's in more than 90, moving around 750,000 vehicles a year. The 1998 RX effectively created the luxury SUV category from nothing, and it remains one of the best-selling nameplates the brand has ever produced. Decades later, the RX Hybrid alone would go on to account for over 40% of all Lexus hybrid sales in a single quarter. proof that the original formula hadn't lost its appeal with buyers. China became one of Lexus's two largest markets in the world, alongside the United States, built almost entirely on imported cars carrying one simple promise: the same craftsmanship as a European badge, for noticeably less money. Industry writers would later sum up the original LS 400 in a single line: more over-engineered than an already over-engineered Mercedes S-Class, more reliable, and somehow less expensive on top of it. That combination is genuinely rare in any industry, let alone one as capital-intensive as automaking, and it's why the formula proved so hard for competitors to copy for so long. For over 3 decades, that promise held under pressure. It survived the 2008 financial crisis. It survived a pandemic that broke half the auto industry's supply chains overnight. It survived the shift from sedans to SUVs, and the more recent shift from gasoline power to hybrid power. The advantage was never really about one car or one ad campaign. It was a persistent structural gap between what Lexus charged and what the car was actually worth, and customers noticed that gap every single time they cross-shopped a showroom. But then something changed, not the cars, the math sitting underneath them. Start with the border. In April 2025, the United States imposed a 25% tariff on imported vehicles and auto parts, sweeping in nearly every car Japan ships to America. A bilateral agreement in September cut the rate to 15% in exchange for major Japanese investment commitments inside the United States. Even at the reduced rate, Toyota said the tariffs would cut its operating income for the fiscal year ending March 2026 by 1.4 trillion yen, close to $9.5 billion. In a statement, Toyota called the tariffs highly disruptive. Across the wider Japanese auto sector, 7 major manufacturers combined are absorbing an estimated hit north of 2.5 trillion yen for that same fiscal year. Here's the specific problem for Lexus, and it's worse than what Toyota faces as a whole. Every model in the Lexus lineup except the TX SUV is built in either Japan or Canada. There is no domestic factory cushion the way Toyota has for the Camry or the RAV4, both built at enormous volume inside a single Kentucky plant capable of producing 550,000 vehicles a year. In August 2025 alone, that plant's RAV4 sales rose 20% to over 42,000 units, and Camry sales rose 14% to roughly 28,500. Total Lexus brand sales across the entire United States that same month came in at 33,368, less than either individual mass-market nameplate on its own. Not only is Lexus fully exposed to the tariff on nearly every unit it sells, its own parent is also now visibly treating it as a lower priority. Toyota has scaled back Lexus ES production at that same Kentucky plant to make room for more Camry and RAV, for hybrid output instead. Compare that to Nissan, which shifted Rogue production onto American soil, or Honda, which moved CR-V assembly from Canada into the United States. Lexus doesn't have that option. Its entire identity was built on precision manufacturing concentrated in Japan, and that same concentration is now the exact thing exposing it to the tariff. Dealers felt it immediately. Some Lexus stores began advertising pre-tariff inventory as a selling point in itself, telling loyal customers to buy now from what stock existed before price changes hit the newer shipments. When a dealership's best marketing pitch becomes "buy this one before the tariff reaches it," that's not a brand operating from strength anymore. Now add currency into the mix. Through 2025 and into 2026, the yen traded in a range of roughly 150 to 156 to the dollar, historically the kind of level that acts as a tailwind for Japanese exporters, since it makes goods built in Japan cheaper to land in dollar terms. But a tariff is not a currency effect. It's a flat toll collected at the border, regardless of what the yen happens to be doing that week, and a weak yen can't discount away a 15% tax applied to every single unit sold. Analysts at JP Morgan put it plainly earlier in the cycle: which companies thrive from here, and which struggle will come down almost entirely to how much of that cost gets passed on to the customer and how much gets eaten. Honda's executive vice president Noriya Kaihara summed up the mood across the entire Japanese auto industry even more bluntly: The tariffs are the new normal. The industry-wide toll for a single quarter alone was estimated at 2.6 trillion yen, taken directly out of operating profit, and Toyota's own operating margin slid from 11.1% to 9.5% in the process. That's not a rounding error on a balance sheet the size of Toyota's. That's the kind of margin compression that forces real decisions about which brand gets the next factory slot and which one doesn't. On paper, this should have been a survivable, containable hit, the kind of headwind a disciplined manufacturer absorbs over a couple of fiscal years. It wasn't because at almost the same moment, Lexus was already bleeding out in the one country where it used to be completely untouchable. So what was actually happening in China? Unlike BMW, Mercedes or Audi, Lexus has never built cars locally through a joint venture. Every single Lexus sold in China is imported, which used to be part of the appeal, a genuine made-in-Japan badge in a market that prizes authenticity. By 2026, that same structure had flipped into a liability. Chinese buyers are being handed a flood of domestically built electric vehicles from BYD, Xiaomi, and a dozen smaller challengers, all undercutting imported luxury brands on price while matching or beating them on in-car technology. Beijing's reinstating a purchase tax on new energy vehicles and trimming trade-in subsidies briefly cooled demand. But the price war among domestic Chinese brands never actually let up, and imported brands took the worst of it. The numbers tell the story on their own. Lexus imports fell from 230,000 units in 2020 to just over 180,000 in 2025, then to under 50,000 in the first 4 months of 2026 alone, a 34% year-over-year drop. It wasn't an isolated Lexus problem either. BMW's China sales fell 44% over a similar stretch. Porsche dropped 46%. Imported luxury sales as a whole category sank 39% industry-wide. Lexus was simply losing the exact game it invented back in 1989, on a new battlefield built entirely by someone else's rules. The war at home was so brutal that even BYD, the domestic EV leader, posted its own sales declines against fresh challengers like Xiaomi and Geely. If the strongest local players were drawing blood from each other on price, an imported brand with no local factory, and none of that pricing flexibility never really had a chance. Meanwhile, back home, Lexus made a second bet that hasn't paid off cleanly either. Its all-electric RZ has spent long stretches sitting on dealer lots with aggressive lease deals attached, while hybrid models like the RX and NX carried waiting lists deep into 2025, at one point falling to an average of just 11 days of inventory supply against an industry average closer to 74 days. Lexus nailed the hybrid demand curve and mistimed the electric one at the exact moment its overseas markets needed a genuinely competitive EV the most. That would have been survivable as an isolated wound, but it landed at the same moment a much closer rival picked up the very playbook Lexus wrote in 1989 and turned it directly back on Lexus itself. Meet Genesis. Spun out of Hyundai in 2015, the brand spent its first decade doing something that should sound extremely familiar by now, pricing meaningfully below German and Japanese rivals, while including more standard equipment than any of them. The 2026 Genesis G70 starts at $43,450 with a 300 horsepower engine as standard equipment. A comparably positioned BMW 330 ICE starts near $48,000 with a 225 horsepower engine. Features that cost extra on a Lexus or an Audi, like advanced driver assistance packages, come standard well down the Genesis trim ladder. The midsize GV80 SUV has been quietly outgrowing sales of the BMW X5, the Mercedes GLE, and yes, the Lexus RX, the very segment Lexus itself invented back in 1998. Genesis is closing in on 250,000 global sales annually, with an internal target of 350,000 units by 2030, and it grew roughly 10% in 2025 even as the broader luxury segment cooled everywhere else. Late last year, US News crowned it the 2026 Best Luxury Car Brand, citing the same combination of pricing and standard features Lexus used to own outright. The brand backed that up with a franchise dealer network and a concierge ownership program built specifically to compete with the white glove service Lexus pioneered decades ago. The automotive press has openly started asking whether Genesis has become the modern Lexus. That question isn't really a compliment aimed at Genesis, it's a warning aimed squarely at Toyota. Same move, different scoreboard decades later. It's worth noting that Genesis wasn't just beating Lexus. In the same US quarter, BMW, Mercedes and Audi all posted sales declines too, with Audi down roughly 30%. Genesis was the only major luxury brand actually growing, while almost everyone else, Lexus included, was shrinking. So Lexus is now losing money at the tariff border, losing volume in its second biggest market on Earth, and losing its own founding advantage to a company barely a decade removed from starting at zero. Which brings us to what all of that actually looks like once you put it on paper. The first quarter of 2026 was ugly. Lexus posted a double-digit sales decline in the United States, even as its own parent brand Toyota stayed roughly flat over the same stretch. Cox Automotive had already warned the broader industry to expect sales to fall this year as tariffs work their way through sticker prices. Kentucky ES production is winding down. China imports are running at a fraction of their 2020 pace. Genesis keeps closing the exact price gap that used to be Lexus's entire reason for existing. A record year turned into a record bad quarter in the time it takes to file one earnings report. $9.5 billion have gone to tariffs. Over 180,000 units gone from China in 5 years. One rival, born about a decade ago, is now wearing the crown Lexus wore for nearly 4 decades. None of this is design failure, none of it is quality failure. The reliability is still there, the engineering is still there. What's actually gone is the arithmetic. The gap that once separated a Lexus sticker price from a German one has narrowed from 3 directions at once. Tariffs on one side, a collapsing home market on another, a hungrier, cheaper competitor is closing in from the third. So what actually killed the Lexus advantage? It came down to 3 shifts. First, trade policy. The same kind of government pressure that pushed Toyota upmarket into building Lexus in the first place is now taxing that same brand at the border 4 decades later. Second, currency. A weak yen used to function as free money for Japanese exporters. Now it's just background noise against a flat tariff bill it can't discount its way out of. Third, and probably the most humbling shift of all, the disruptor playbook got copied by someone newer, hungrier, and with far less to lose than a 37-year-old luxury division. None of these 3 forces required Lexus to make a single engineering mistake. That's what makes this story different from the usual tale of a brand losing its way. Lexus didn't lose its way. The ground underneath it moved. If a brand built entirely on out-executing Mercedes on price and quality can get out-executed on those same terms, no legacy is actually safe from arithmetic. If a breakdown like this can happen to a company as disciplined as Toyota, subscribe, because we track exactly where these cracks show up next, before the headlines catch on.